All right, what is the single best entity for your rental properties? Is it an S-Corp or a pass-through LLC? This is one of the biggest decisions you're gonna make as a real estate investor, and I'm telling you, getting it wrong can cost you an absolute fortune. Today, we are breaking down why the most common advice you'll hear is actually a massive trap for rental property owners. You've heard this, right? I bet you have. Your CPA, your buddy, maybe some guru on YouTube, they all tell you the same thing. You gotta make that S-Corp election. It's this amazing secret key that's gonna save you thousands and thousands of dollars in self-employment taxes. And on the surface, it sounds incredible. But here's the thing, here's the catch. When we're talking specifically about your buy and hold long-term rental properties, that advice might not just be a little off, it could be actively costing you money and creating a ton of headaches you do not want down the road.
Look, following this popular advice without understanding the crucial, and I mean crucial, nuances for real estate is a trap. And I promise by the end of this explainer, you're gonna know exactly why, when an S-Corp actually does make sense, and what structure you should probably be using instead for your rentals.
Okay, so let's dive into this. We're gonna start by totally busting the biggest myth about S-Corps for rentals. Then we'll get into the 3 major traps that catch so many investors. After that, we'll cover when S-Corps are actually the right tool, lay out the ideal structure for rentals, and finally, give you a super clear framework to make the right call.
All right, section 1. So let's get right down to the fundamentals. Why is everybody so obsessed with S-Corps in the first place? Well, it really boils down to one huge tax-saving feature. And for active business owners, it is incredibly powerful. The whole appeal, the #1 selling point, is avoiding those painful self-employment taxes. So if your active business makes, say, 80 grand, you can pay yourself a reasonable salary of 40,000, which, yep, that gets hit with a 15.3% tax. But the other 40,000, you take that as a distribution and boom, it's not subject to that tax. That's a savings of over $6,000. For the right business, that's an amazing benefit. And this is the giant misconception. This is the critical piece of the puzzle that almost everyone misses. The IRS, for the most part, views the income from your rental properties as passive income. And guess what? Passive income is not subject to self-employment taxes in the first place.
So let that sink in. The crucial point here is you're using this complex structure, the S-Corp, to solve a tax problem that you simply don't have with your rental properties. You are bringing a bazooka to a knife fight that isn't even happening. This is the foundational mistake, and it leads to all the other problems we're about to cover.
Okay, so now let's see how this one little mistake snowballs into a really big problem. Choosing S-Corp status for your rentals doesn't just not help. It can actively hurt your portfolio and your bank account in 3 really significant ways. Let me make this real for you. Let's talk about an investor. We'll call her Sarah. For 3 years, she ran her rental portfolio through an S-Corp because her CPA told her to. But when someone finally analyzed her situation, it turned out she was paying more in taxes and losing out on valuable deductions that cost her somewhere between $12,000 and $15,000 a year. Let's see how that happens.
These are the 3 landmines just waiting for you. First, you've got the reasonable compensation trap. Second, you lose a huge tax rate called the QBI deduction. And third, the one that's an absolute nightmare for investors, the deemed sale. We're gonna break every single one down right now. So here's trap number 1, and it's kind of ironic, right? Once you elect S-Corp status, the IRS requires you to pay yourself a reasonable salary for the work you do. Managing the property, finding tenants, all that. So you are literally forced to take your passive rental income, which was not subject to payroll taxes, put yourself on payroll, and voluntarily start paying those exact taxes you were trying to avoid. It makes no sense. And that brings us to trap number 2, losing a big chunk of the qualified business income or QBI deduction. This is a massive tax break that an S-Corp can seriously mess up. With a simple pass-through LLC, you can deduct up to 20% of your rental income. So on $100,000 of profit, that's a $20,000 deduction. Awesome. But in an S-Corp, if you pay yourself a $50,000 salary, that salary doesn't qualify. The deduction is now only based on the leftover profit. You just sliced your deduction in half and basically handed the IRS an extra 10 grand. And this brings us to trap number 3. And honestly, this is the one that should keep you up at night. Let's say you own a property inside your S-Corp and you need to pull it out to do a cash-out refi, which is a super common strategy. With a pass-through LLC, no big deal. With an S-Corp, the IRS looks at that simple transfer to yourself and calls it a sale.
And here's how that deemed sale nightmare actually plays out. Let's say your property has a tax basis of $150,000, but it's now worth $300,000. The moment you deed that property out of the S-Corp back to your personal name, the IRS goes, hey, you just sold an asset. And they send you a tax bill on $150,000 of ghost income. That's profit you never even received in cash. It is a massive, totally unexpected tax liability from a simple paper transaction. So you might be sitting there thinking, oh my gosh, why would anyone ever use an S-Corp then? Well, they aren't always bad. Not at all. They are an incredibly powerful tool, but they have to be used for the right job. And that job is for businesses that generate active income. This is where the S-Corp is an absolute superstar. If you're flipping houses, wholesaling properties, or running a big property management company, your income is considered active. It's a job. In these cases, using an S-Corp lets you use that awesome salary and distribution strategy to legitimately and significantly save on self-employment taxes.
And hey, what if you have a mixed business? Maybe you run a construction company and a property management arm. You've got to structure it the right way. You'd have your main S-Corp for the active contracting business. Then you'd create a separate child LLC for the property management side that's owned by the S-Corp. Why? This isolates your liability. If someone sues the property management side, your main contracting business and all its assets are completely shielded. It's just smart protection.
Okay, so if the S-Corp is the wrong tool for your buy and hold rentals, what is the right one? Well, the ideal structure is all about hitting three goals: simplicity, asset protection, and maximum tax efficiency. Here it is. This is the gold standard. You put each rental property into its own single-member LLC. This is disregarded for tax purposes, so the income just passes through. The real benefit here is that it isolates liability. A slip and fall at property A can't take down property B. Then, all of these property LLCs are owned by one holding company LLC, which a lot of savvy investors set up in a state like Wyoming for its great privacy and asset protection laws. This holding company is taxed as a partnership, and all that beautiful passive income flows right to your personal tax return. It is clean, protected, and super efficient. So let's bring all this home. I know it can seem complicated, but the choice for your portfolio really comes down to a pretty simple framework. And it's all based on the type of income you're actually generating. This table makes the choice crystal clear. Just look. If your income is primarily from rentals, your main goal is to maximize that QBI deduction and keep things simple, and you need the flexibility to move properties around, you stick with a simple pass-through LLC structure. It's a no-brainer. Now look at the right. If you're flipping, wholesaling, and your number one goal is saving on self-employment tax from that active income, then yeah, an S-Corp is a powerful tool you should absolutely consider. At the end of the day, your entity structure should be a tool that supports your wealth building strategy. It shouldn't complicate it, and it definitely shouldn't create unnecessary tax bills. So the question I want you to ask yourself is this: is my current structure truly working for me? Is it pushing my wealth forward, or is it a ticking time bomb of hidden liabilities and lost deductions? This is the Brick by Brick channel, where we help beginners build wealth through real estate one brick at a time. If you got value from this, do me a favor and hit that like and subscribe button for weekly investor breakdowns just like this one.